Hi there, you're watching Market Cafe on ET Now with me, Shreyansi Singh, and over the next 1 hour, I'll take you through news and updates from within the country as well as across the globe, tell you which stocks you should keep on your radar, and tell you what the brokerages are saying as well. But first things first, let's take a look at what the global markets did. Firstly, let's take a look at US stock futures that inched higher after the Nasdaq Composite's worst session since 2022 amid investors' rotation out of big tech high flyers. When you take a look at Dow Jones Industrial Average Futures as well, you're looking at a rise coming in of about 0.2% there as well. And S&P 500 futures and Nasdaq 100 futures also climbed about 0.2% and 0.3% respectively. Now the tech-heavy Nasdaq tumbled 2.8% in its worst day since December 2022, like I mentioned before, closing below 18,000 for the first time since July 1st. When you take a look at the S&P 500, then you're also looking at a decline coming in of about 1.4% there as well. However, you did have the blue chip Dow, which has less exposure to the tech trade than the other two indexes, and that is the one that outperformed. Now the 30 stock index gained about 243 points or 0.6% thereabout, closed above that 41,000 level for the first time ever as well. Now Wall Street has been dumping shares of this year's artificial intelligence beneficiaries as the growing likelihood of the September rate cut bolstered optimism in the broader market as well. So when you take a look at the Russell 2000, you're looking at declines coming in of about 1%, but the small cap index has jumped more than 9% in the last 5 trading days. Now investors have been hoping for a broadening market amid concerns that the tech-driven rally is running out of steam. So that is the larger theme that you're seeing play out when it comes to Wall Street. And on the economic front, then you do have the jobless claims for the week ending July 13 that are due on Thursday morning. Now, economists are expecting to see claims come in at 229,000 per June, and that's up from 222,000 from the week before as well. So that largely is the handover that we see coming in from the US markets as well. When you take a look at the European stocks, you're looking at a lower close coming in, and it was the tech stocks that plunged. When you take a look at the European stocks and regional stock 600 index also provisionally closed a tad bit lower as well. Moving on then, let's take a quick look at what crude did and also what gold prices did. Firstly, let's take a look at oil then. And oil prices ticked higher on Thursday, but by a bigger than expected weekly decline in US crude stocks. So when I'm looking at Brent futures, you're looking at an uptick coming in of about 0.2% there as well. US WTI as well, a 0.4% uptick there as well. And US crude inventories, when I'm looking at them, fell by 4.9 million barrels last week. Data from the EIA showed that, and that compares with a 30,000 barrel decline forecast that was being penciled in previously. Let's also take a look at some factors on the demand side then, because the prospects of cuts in interest rates in coming months in the United States as well as Europe help to support the market as well. Now, mind you, lower interest rates often spark buying and boost oil demand as well. So that is the kind of picture that we have, at least for oil prices. And investors are also awaiting news from a key leadership gathering in China that is to end on Thursday as well. So that is also something that the oil market is keeping on its radar as well. Let's also take a quick look at what gold did, because gold is just a little bit after hitting that fresh record high. So gold prices extended their rise to a fresh all-time high on Wednesday, and that was as growing optimism for an interest rate cut from the US Federal Reserve in September, as well as a weaker dollar bolstered demand for gold prices. So that is the kind of handover that you've seen coming in. Let's also take a quick look at spot gold, because that after hitting those record high levels, that is about 0.2%, and in terms of price levels then, it was around those $2,400 per ounce levels. But Snehi, what are the key events that we're looking out for then?
Well, absolutely lots to watch out for today, Shreyansi. Hi there, good morning. We're coming back from a truncated week, a market holiday yesterday. So lots to watch out for today. Let's take a look. And today being Thursday, it's the weekly Nifty expiry. So, well, watch out for any volatility on the back of that, because remember, this is the last weekly expiry before the biggest event will hit us this month, and that is the union budget. So expect some volatility, but well, keep a close eye on the markets on that note. Shifting focus to some global cues then. Today, initial jobless claims data comes out from the US. You have jobless claims as well as unemployment data coming out of UK as well, and from Eurozone today. Very, very important day coming in. You have the ECB rate decision. Now remember, last time this happened, ECB went ahead and cut rates even before Fed did. So let's keep a close eye and see if they maintain where they are, if they maintain a stable rate or they implement a further cut. Very interesting to watch out what will happen today, and Christine Lagarde's comments also will be very interesting to watch out on that note. Moving on, let's also talk about some global earnings. Then Netflix will be coming out with its numbers today, so we'll see how the street reacts to that and how Wall Street will open later today on the back of these numbers. And let's shift focus back home, talk about some nifty earnings here as well. And from the Nifty pack, you have Infosys reporting its numbers. Remember, last week TCS, HCL Tech were both out. Today, you also have the Wipro AGM and Infosys numbers. So, well, the entire IT pack is going to be in focus today. Moving on, let's also talk about some earnings that are expected to come out from the non-Nifty pack. And mind you, that's a lot of numbers coming today. You have Tata Communications, Mastech, Persistent Systems, L&T Tech. So, L&T Tech persistent yet again on the IT front. So, IT is going to be a basket to watch out for today. You have Dalmia Bharat, you have Tata Tech, Polycab, so lots of earnings coming out. Moving on, let's talk about some corporate action. Like I mentioned, Wipro AGM will take place today. You have the KPI Green stock split happening today from rupees 10 per share face value to rupees 5. So watch out for that. And you have the Elecon Engineering stock split also happening from face value rupees 2 to rupees 1. So keep a close eye on both of these stocks. Hotco and Tata Communications will be in focus because both of these boards will be meeting to mull fundraising. So keep a close eye on any developments on this front as well. Aurobindo Pharma will be mulling a share buyback today, so very interesting to watch out for. And reports are indicating that MRF is going to undertake a price hike today, so the tire space is also going to be largely in focus. Other than that, it's the last day to buy shares of a whole host of companies like Advanced Enzymes, Amara Raja, Arvind Smart Spaces, Praj, Panasonic, UTI, AMC, Newgen to be eligible for their interim dividends. So watch out for all of these stocks as well. Lock-in period ends for Rashi Peripherals today. 5% equity comes out of lock-in. In terms of other events, you have Telangana government will be rolling out a crop loan waiver. So keep a close eye on microfinance institutions today and that basket of stocks, because there could be some activity in those on the back of this news flow. You have Supreme Court that will be hearing the NEET UG pleas today, so watch out for that. Globally, you do have the Japan trade data also coming out anytime soon. Fed members, some commentary expected from the Fed. You have Mary Daly, Lori Logan, as well as Governor Michelle Bowman will also be speaking, and Donald Trump will be speaking in Wisconsin after that accident that he had last week. So lots of important cues taking place today. Keep a close eye on all of these developments.
Well, absolutely, Snehi. Lots of important cues and lots of important commentary to keep an eye on. But let's kickstart our coverage this morning with the key takeaways from the Federal Reserve's Beach Book. US economic activity seemed to have softened in the past 2 months, with 5 of the Federal Reserve's 12 regions reporting flat or declining activity. Now, economic uncertainty largely attributed to the upcoming election, geopolitical conflict and inflation. The report also showed that in a sign of further cooling in the labour market, several districts saw improvement in labour supply conditions as turnover declined, reducing demand to find new workers as well. The pace of inflation seen modest, with most areas showing signs of stabilization in input costs as well.
Alright, and let's keep it going with some central bank news coming in. We're already getting some commentary coming in, and top Federal Reserve officials indicate that the US Central Bank is closer to cutting interest rates given inflation's improved trajectory, and the labour market also looks to be in a better balance. These are the remarks that set the stage for the first reduction in borrowing costs in September. Now, Fed Governor Christopher Waller and New York Fed President John Williams both noted that shortening horizon towards looser monetary policy is going to be something on the focus. Additionally, Richmond Fed President Thomas Barkin said he is very encouraged that the inflation cool-off is broadening. Now, these remarks follow Fed Chair Jerome Powell's optimism over the continued disinflationary trend that began last year, despite a short-lived bump in inflation earlier this year.
Well, it wasn't a good day for the Wall Street for everything but the Dow, but meanwhile, Wall Street's semiconductor index lost more than $500 billion in stock market value in what was its worst session since 2020, after reports said the United States was mulling tighter curbs on exports of advanced semiconductor technology in China. Remarks from Republican presidential nominee Donald Trump saying key production hub Taiwan should pay the United States for its defense-deepened selling in chip stocks. The latest worries for chip investors come after Washington in recent years has adopted a more protective stance for the US semiconductor manufacturing industry as well.
Let's keep it going with Wall Street. Focus on some earnings that came out. And German sportswear brand Adidas soared after the company raised its full-year guidance for the second time this year. Move comes after Adidas reported strong second quarter numbers. Meanwhile, Johnson & Johnson has beat its second quarter profit and revenue estimates, largely driven by strong drug sales. The New Jersey-based drug maker now expects 2024 sales of $89.2 billion versus the prior forecast of $88.7 to $89.1 billion.
Moving on then to some macroeconomic data, then British inflation holds steady at 2% for the month of June, defying forecast for a slight fall. The headline reading came in above analysts' expectations at 1.9%, in line with the previous 2% reading in May as well. Remember, consumers are increasing their spending on leisure activities over the summer months, including on cultural experiences as well as concerts, as you do have high-profile artists, the likes of Taylor Swift, Bruce Springsteen, Pink and Sting touring the country as well. Investors have been eyeing a potential August interest rate cut as headline inflation showed signs of sustained easing. Market expectations of such a trim waned just after the release of the latest print as well.
Alright, let's move on. Take a look at some macro data coming in. The International Monetary Fund, or the IMF, has raised India's growth projection for FY25 by 20 bips to 7%. The IMF has cited strong prospects for private consumption, specifically in rural areas. The GDP growth is expected to slow down in FY25 to 6.5%. Speaking of global economy, the IMF predicts a 3.2% growth in 2024. Listen into the word coming in from Pierre-Olivier Gourinchas, the chief economist at IMF.
Global growth remains steady at 3.2% this year, unchanged from our April World Economic Outlook, and slightly higher at 3.3% next year. But there have been some notable developments since April. First, growth in major advanced economies is becoming more aligned as output gaps are closing. In the United States, we see increasing signs of cooling. In the euro area, meanwhile, growth is picking up. Asia's emerging market economies remain the main engine for the global economy. Growth in India and China is revised upwards and accounts for almost half of global growth. Yet prospects for the next 5 years remain weak.
All right, then that's important commentary coming in from the IMF, but it's time for a quick break. When we come back, we'll take a look at how the Asian markets are faring, so you don't go anywhere.
Hi there, welcome back. You're still watching Market Cafe on ET now. Let's take a look at how the Asian markets have opened up, and I'm going to give you a heads up. It's not looking good at all. In fact, what we're seeing on the screen seems to be a sharp recovery for Nikkei coming in, because last when I checked, Nikkei was tanking in trade. So we'll just get some more clarity on what Nikkei is doing, because those levels seem to be wrong. Can we just, it's okay, let's move on. Let's talk about some other market as of now. But largely when you take a look at Asia Pacific markets, they're plummeting as chip-related stocks have dropped following reports of more stringent export restrictions from the US. You have comments coming in from US ex-President Donald Trump. That has raised geopolitical tensions as well. Remember, you have NASDAQ that has done really badly in yesterday's trade. Lots of global pressure coming in on Asian markets as well. Now, Nikkei, when it opened, it declined more than 2%. Topics also dropped 1.1%, and this is on the back of some trade data that the street was gauging. Now, Japan's export rose 5.4% on a year-on-year basis in June, a steep decline from 13.5% in May. So that's a very sharp drop coming in. Imports grew 3.2% year-on-year last month, down from 9.5% in May. Both imports and exports missed Reuters' expectations of 6.4 and 9%, 9.3 in fact. Growth respectively. Japan's trade balance reversed from a 1.2 trillion yen deficit in May, or 7.7 billion, to a 224 billion yen surplus. So maybe on the back of that, we're seeing some positivity coming in Nikkei, but largely still looking under pressure. Moving on, let's talk about South Korea, and let's talk about what the Kospi is doing as of now, because Kospi also as of now seeming to be in the green, but we'll just double check on those rates, because as of now Kospi also looks largely under pressure, and Kospi also dipped 1.3% on open. You have this small cap Kostak that has lost 1.5%, and this is on the back of Samsung Electronics falling 1.5% on the back of that chip news coming in from the US. Moving on, let's talk about Australia also, because that index has also dipped marginally. Investors are waiting for employment data to be released later in the day. So as of now, let's take a look at what ASX 200 is up to. Slightly under pressure, not doing much, 0.2% lower is where the ASX is. Moving on, let's also address what Hang Seng and Shanghai are up to. And as of now, what I can see on my screen, Hang Seng looks to be largely under pressure, 1.5% drop coming in for Hang Seng as of now, close to a 300-point cut coming in. Let's lastly also take a look at what Shanghai is doing, and Shanghai also seeming to be largely under pressure, but trying to stage a recovery is what Shanghai is doing. So we'll just keep an eye out on all of these indices, because Asian markets seem to be largely under pressure. But on the flip side, where we are seeing some positivity, and it is really surprising given how weak the global handover is looking like. When you take a look at what the Nifty closed at day before yesterday, we managed to close at 24,613, slightly above 24,600. You have Nifty implying an open of 24,733. So even on the spot basis, it is a gap up start of more than 120 points coming in. On the futures basis, it is a very good positive solid start coming in of more than 100 points as well. So well, we'll just take a back seat, let the market do its thing, and take a look at what the market does today, given the global handover is largely weak, and also today is Nifty expiry, Shansi.
Well, absolutely, Snehi. It does look like it's going to be a good day for us, and we're going to be possibly outperforming like the Dow did against that backdrop with the rest of the Wall Street sort of tumbling, and with that weak handover that we also have against that backdrop is still likely to do good. So let's see how that pans out for us. But moving on then, e-commerce major Amazon announced its 2 days Prime Day sale, which will offer great deals, new launches and blockbuster entertainment for their Prime members. This 2-day mega sale will take place on July 20th and 21st. Welcome back. Thank you so much for staying tuned in. On to an ET Now exclusive then. We learned from reliable sources that steel companies have reached out for government intervention on imports, and they're looking at lofty steel imports, and that is something that they've flagged to the government as well. We have my colleague Prakash Priyadarshi who's joining in with more updates. Prakash.
Yes, we are learning from our sources that the steel companies have approached government on rising steel imports in the country. Sources are informing that the companies have made a presentation to the steel ministry as to how steel imports are constantly growing under various segments. Therefore, these companies have urged government for urgent intervention by increasing import duties. Along with that, we have also been informed by our sources that the steel ministry has apprised Ministry of Finance about the current status. In fact, a separate presentation has also been made to the Finance Ministry. The industry has also urged government to increase custom duty on various steel products to 12.5% from existing 7.5% in order to check rising steel imports. After considering all these factors, the Finance Ministry has sought more information from the nodal ministry like Ministry of Steel and Ministry of Commerce before taking any call. Industry also wants government to announce a hike in custom duty on various steel products in order to check rising steel imports in the upcoming budget.
All right, Prakash, thanks for all of those details coming in. But we also caught up with economist TV Mohandas Pai, and he shared what his budget wish list looks like this year. Let's go across and listen.
Budget has to be very broad, and budgets has to set the tone for the next 5 years, because whatever comes in the budget and is improved, that could have impact, because it'll play out in the next 5 years. So my view is that there must be more spending on infrastructure, faster spending for roads and railways. Second, there must be more money on housing and social programs. Third, we need a large DBT program for the poor, because 50% of population depends on agriculture, where the income is not growing fast. compared to people in industry and services. We must shift people from agriculture, industry and services, happening slowly. But right now, the income is not going same place. There's a great degree of discontent. So I think it's important for government to have a DBT program, say pay 2,000 rupees to every woman who's getting a gas stove, subsidized gas. That is 10 crore people.
All right, then let's move on and listen into the word coming in from Rajiv Chaba, CEO Emeritus, JSW MG Motor India, in an exclusive conversation with ET Now, where he shares his expectation from this year's budget as well.
In more matured markets, developed markets, is a non-event. You know, in our country, due to historical reasons, it's become an event. But the expectation would be no shock, no surprise on the negative side, continuation of building of infrastructure in the country, including roads obviously, which helps the auto industry in general. Also continuation of the policies, especially the EVification. We are following exactly what government told us to do. So we are pushing a lot on the EV side and continuation of that balanced duty structure on the EV. I think not really tweaking it in favor of this or that, which changes the balance of the duty structure, should not be there. So no surprise hopefully on the GST structure. And third thing I would say, because EV is good for the country, is good for the environment, and the government wants to push it, so I think some more emphasis and focus has to be on the EV charging infrastructure.
All right, let's get a move on then. And Harsha V. Agarwal, the senior VP at FICCI, discusses his expectations from the upcoming union budget. He believes that the government's focus will be on investments and that will continue. He's also penciling in some improvement to come in for the consumption space. So let's go across and listen in.
Around here, we are seeing an increase in private investment. And going forward, I think government are going to introduce a lot of initiatives, apart from, because government's focus is more on investment, which will further help in increasing the investment from the private sector also. So I think it's a trend is good. And hopefully, as we move forward, from 24%, I think next 2-3 years, it might go up to 30%.
Mr. Agarwal, the business and the company which you represent, in a sense, is a real proxy to consumer demand and what is happening to the consumption cycle. Now, indirectly, consumption has really been on the back burner, looking at the data points of FMCG, or for that matter, even the two-wheeler sales. What is that balancing act which could be done in this budget, where commitment towards infrastructure is not compromised, but a push towards consumption revival kicks in without compromising on the macro picture?
I think the focus of the government has been, and going forward, I think what is important is that it has to be investment which is leading inclusive growth. And for that, I think skill development is something, which will be important. Employment generation is what is important, and the capital expenditure increase will certainly help in those areas. Monsoon certainly, plays a very important role from the perspective of increasing the consumption. And hopefully so this year, it is predicted, and we believe, the monsoon should be good, which will also have a positive effect on the consumption. And overall, what we see, in comparison to last year, we do see some sort of improvement in the consumption.
All right, then that's what the budget wish list looks like. Let's move on then. SEBI unveils plans to introduce a new asset class aimed at high-risk taking investors, which could potentially bridge the gap between mutual funds as well as portfolio management services. My colleague Ankur Mishra is standing by with more details. Ankur, tell us more. What is the minimum investment threshold looking like for this?
Yes, in a bid to deter the investors from going after the unregistered portfolio management services, SEBI has now proposed that mutual funds can have funds like long short funds. What it means, it has proposed to create a new asset class for investors, and this asset class will have flexibility in terms of regulation from SEBI. Now, this asset class will have flexibility to invest in derivative products. Remember, currently mutual funds are only allowed to invest in derivatives if it is a hedging kind of strategy. Otherwise, that asset class is not permitted, and now SEBI has proposed that derivatives may be allowed for the purpose of taking exposure by mutual funds. Now, what happens for investors? There is a proposal that minimum investment size of rupees 10 lakh should be there for the investors, and this in turn will prevent the retail investors from going for this high risk asset category. However, it will bridge the gap between mutual funds as well as portfolio management services, and more so for the people who were going for unregistered kind of PMS.
Alright, thanks Ankur for all of those important details coming in. Then let's move on. Zee Entertainment launched a foreign currency convertible bonds or FCCB issue with an aim to raise 1,997 crores. Now the FCCBs will be issued to Resonance Opportunities Fund, St. John's Wood Fund and Ibisu Global Opportunities as well. These FCCBs will carry a coupon of 5% per annum with a maturity period of 10 years, and in case all the FCCBs are converted to equity shares, the conversion price would be 160.2 rupees per share. Now, the company could have to issue 124.6 million shares, that is 13% of current equity base as well. And there's still lack of clarity on the use of proceeds, but Zee had net cash of 1,200 crores as of financial year 24, and it also plans to spread out the drawdown of proceeds in multiple tranches as well. In terms of deployment of funds, that could be opportunistic or on a case-to-case basis as well. Now let's also take a quick look at these proposed investors and their other Indian investments then. So when you take a look at Resonance Opportunities Fund, you're looking at the likes of Modern Engineering, Best Agro, Lancer Container, Electro Steel Castings, as well as Uniforce Enterprises that make it to their list of Indian investments. And when you take a look at Ibisu Global Opportunities as well, you're looking at the likes of Salazar Techno, Paisalo Digital, Rosell India, Omax, as well as Deep Energy that make it to their portfolio of Indian investments as well. So that largely is the fine print coming in from this FCCB issue, Snehi. But what are the brokerages saying about this then?
Absolutely. So you have a note coming in from CLSE this morning on their take about this fundraising plan, and they've maintained a hold rating with a target price of 150 rupees per share. They say that Zee's fundraising plan is coming at a time when the company already has the cash of 1,200 crore rupees with low capex requirements. Also, they're saying that Zee is past its peak investments in OTT as well as Z5 as well as its working capital needs, and India's media sector, although it is competitive as of now, it's slowly seeming to be changing with the upcoming joint venture between Reliance as well as Walt Disney. And CLSE is also noting that meanwhile Zee's low promoter ownership of 4% continues to remain a key challenge for the company going ahead. So rather mixed note coming in from CLSE this morning on Zee Entertainment. Maintain a hold rating with a target price of 150 rupees per share.
Well, absolutely. With that, it's time for a quick break. When we come back, we'll take a look at what other news and updates we have.
Hi there, welcome back. Still watching Market Cafe on ET Now. Thank you so much for still staying tuned with us. Let's talk about a nifty earnings that came yesterday, and that is Asian Paints. Now, numbers on the Q1 slightly weaker than expected on volumes and margins, at least. That's what the review was like for Asian Paints. But let's also listen into what the management had to say, what their forecast is on growth and inflation as well. Listen in.
April and May were definitely not very good months in terms of what we saw. There was a recovery in the month of June, definitely, which we saw post the elections to that extent, which is there. And this was also a quarter where we started some shoots of recovery in the rural demand also. One worry obviously is inflation. We have seen inflation which is there to about 1.8% in Q1. We have also taken a price increase of about 1%, which has already been done. We see further challenges which are going to happen in terms of looking at further inflation, which we expect could be in the range of about anywhere between 1.4, 1.5%, and therefore possibly we could see further price increases as we kind of go forward to that extent.
All right, MD and CEO at Asian Paints penciling in a further price hike, but let's also take a look at brokerage notes on Asian Paints. And yesterday you also had LTI Mindtree that came out with its numbers. So you have Goldman Sachs and JP Morgan, they've maintained a neutral stance on Asian Paints. Investec has maintained a sell rating on LTI Mindtree. My colleague Jinay is here with more details on these brokerage notes and what they are making out of both of these companies' Q1 results. Jinay.
Well, yes, so Asian Paints, poor set of numbers. But if we talk about brokerages note, we have a note from Goldman Sachs. They have maintained their neutral rating and have cut the target price to rupees 2,750. What they believe is that Q1 was a sharp EBITDA decline, which led to a poor set of numbers. Also, they believe that headwinds will persist going forward as well. Now, the impact of increased competitive intensity is also likely to be there, which will maintain a pressure for the company going ahead. We also have a note by JP Morgan on the company. They have also maintained their neutral rating and have cut the target price to rupees 2,800. What they believe that earnings was missed on the back of weak margins and tepid revenue growth. They believe from Q2 onwards, price hikes and rural demand will aid the growth, but as of now, they see price reaction to be negative on back of the results. Moving on, if we talk about LTI Mindtree, Investec came up with a report. They have maintained the sell rating, but have hiked the target price to rupees 5,370, back on good set of numbers. What they believe, if you look at all the IT company set of numbers, reporting set of numbers, LTI Mindtree have reported a better set of numbers when compared to that, and on back of this they have increased their PE multiple target to 25 times, citing potential recovery in the stock. Also, they see their own EBIT percentage getting cut from 15.9% to 15.4%, and they believe that from here on, in order to make better returns, the revenue has to be stronger.
Okay, Janai, thanks for taking us through all of those brokerage notes on LTI Mindtree as well as Asian Paints. But we also do have a handful of brokerage houses coming out with notes on Eicher Motors. You have the likes of CLSA, Goldman Sachs, to Citi, Nomura and Morgan Stanley. All of these firms have come out with notes on Eicher Motors this morning. My colleague Sharad is here with a summation of all of these notes. Sharad, good morning.
Well, yes, the brokerages seem to have given a green thumbs up to Royal Enfield and Eicher Motors, as Citi has stated that Gorilla 450 will provide a good upgrade option to the current 350cc of Royal Enfield owners. Now, also the bike is expected to support the export volumes of the company, aiding the revenue and the profitability. On the other hand, Nomura also, they has stated a kind of a mixed view on it, that they stated that Gorilla 450 may not be able to revive growth, and the price it has roughly 35% premium to the current RE350cc bikes and 3% premium when it comes to the Triumph Speed 400. Also, Morgan Stanley has stated that despite the 36,000 lower price, there is a limited cannibalization risk compared to the Himalayan, which is meaningfully a different value proposition. So overall, the platform sharing will also support the scale gains going ahead for Royal Enfield. And also CLSA has stated that the variants of Gorilla 440 will be actually priced higher than Hero Maverick as well as the Triumph Speed brands. Now, the variants are also competitively priced when it compares to Hero Harley. Now, also importantly, they have stated that there might be market share lose in the segment as competitors are also continuing to scale up. And Goldman Sachs, largely they have stated that the three variants pricing is there actually on the lower side as compared to the overall peers, and they have also stated that the introduction of this Gorilla 450 in the roadster category should help bolster the upgrade ladder for the 350cc users. But largely it has been an inline to strong update coming in from the brokerages on the new launch of Royal Enfield.
All right, Sharad, thanks so much for that. New launch coming in from Royal Enfield today. Eicher Motors largely to remain in focus on the back of that new launch. Let's move on and let's talk about grain-based ethanol manufacturers. They are facing financial stress as the hike in feedstock price doesn't reflect in the government fixed ethanol prices. This impacts smaller players the most and benefits the listed players in market share. Now, which are the stocks that stand to benefit from this? My colleague Ashesha, who tracks this sector closely, is joining us with all of those details. Ashesha, good morning.
Well, yes, grain-based ethanol manufacturers will be in focus today, and that is because smaller dedicated ethanol mills have stated that they are under financial distress on account of rising raw material prices, that is the livestock prices, and the fact that government and oil marketing companies have not proportionately increased ethanol prices over the last couple of months. First up, let's talk about livestock prices. They've also said that broken rice prices over the last 6 months have risen from about 22 to 24 rupees per kg to 27 to 28 rupees per kg. As far as broken rice prices are concerned and maize prices are concerned, both of them have risen substantially over the last 6 months, and that is the reason they are under financial distress. Now, INCRED has come out with a report, and they say that the fact that these smaller players are facing trouble is a benefit for larger listed players, the likes of Gulshan Polyols, BCL Industries and Global Spirits. They also say that consolidation in the industry is expected to continue, and larger listed players will continue to enjoy market share gains going forward. Remember, they have ad rating on all these 3 counters. Apart from this, increase in maize prices is also expected to negatively impact consumers or users of maize, which includes the likes of Venky's and Godrej Agrovet within the poultry and cattle field businesses, and Gujarat Ambuja and Gulshan Polyols within starch and processed food industry. So on account of increase in livestock prices, we have all these counters that are expected to be in focus today.
Sure, thanks so much. So keep a close eye on all of those counters. But let's quickly move on. Take a look at the Asian markets once again, because they seem to be largely tanking in today's trade. Very quickly, let's take a look at what Nikkei is up to. 1.7% cut coming in. Pardon me, that's deepened more. 2% cut coming in. More than 800 points lower is where the Nikkei is as of now, on the back of weaker than expected trade data. Moving on, let's also quickly take a look at Kospi, 1.3% lower as of now. Hang Seng is one I want to talk about, because that was largely lower by almost 300 points, has staged a very smart recovery. As of now, only 0.5% down, a 92-point cut coming in over there. Shanghai and ASX also continue to languish in the red. What I also want to draw your attention to is the Nifty implied open level. Now, remember, we told you the global handle was looking rather weak, and now the Nifty implied open indicating only a 14-point uptick on the futures basis, when earlier, just half an hour ago, it was indicating more than a 100-point gap up open. So that's where the implied open is as of now. So, well, lots to watch out for and lots to buck for in today's trading session.
Well, absolutely, and we were just talking about how it is surprising, right?
Absolutely.
With that handover that Nifty implied was surprising us, and it's continued to surprise us yet again. Let's see how that pans out for us. But with that, we're completely out of time in this edition of Market Cafe on ET Now. From me, Shreyansi Singh, Snehisha, as well as the entire team that put this show together, thank you so much for tuning in. You don't go anywhere, because the market takes all of the action forward.
If you like this video, then like, share and subscribe to ET Now.